Hey everyone, welcome back to Talk Tickers. You know us for our earnings call deep dives, but today we're going to shift gears a bit. We're going to tackle some breaking news.
Sounds good.
Yeah, this is a big one. U.S. credit card defaults just hit a 14-year high.
Oh, wow.
Yeah, pretty alarming, right? It's got the financial world buzzing for sure.
Definitely makes you wonder what's going on.
Exactly. And that's why we're here today. We need to go beyond those scary headlines and really understand what this means.
Right. Break it down.
Yep.
Yeah.
What's driving this trend? What does it mean for the economy? And most importantly for our listeners, what questions should this be raising for you?
That's the key right there. It's easy to get caught up in the fear, but we need to dig deeper.
Absolutely. So let's start with the facts. The latest data shows that the credit card net charge-off rate hit 4.82% in Q2 2024.
Wow.
That's the highest since Q3 2011, to put it in perspective.
Yeah, and it's not just credit cards either. We're seeing charge-offs rising across the entire banking industry.
Exactly. That's a pretty big red flag.
Yeah.
That suggests there's something bigger at play here.
Definitely. Now, here's where things get interesting. Total household debt, IS rising. But income growth is actually outpacing it.
Hold on, so people are making more money, but they're also defaulting more? That doesn't seem to add up.
It's a bit of a head scratcher, right? It tells us that there are some strong forces at work here, pushing people towards financial trouble, even though their incomes are going up.
So how do we make sense of that?
Well, we have to remember what charge-offs actually represent. It's debt that lenders have basically given up on. It's uncollectible. So when those numbers go up, it means more people are having a really hard time keeping up with their payments.
Okay, so defaults are up even with income growth. That's our starting point. Now, the big question is WHY. What's pushing people over the edge?
Right, we got to figure out the culprit.
Yeah.
So there are a few main suspects. We've got inflation, of course.
Right, that's been the big story for a while now.
Exactly. Even if you're earning more, if prices are rising even faster, your purchasing power is shrinking. It's like running on a treadmill.
Yeah, you're putting in the effort, but you're not really getting anywhere.
Exactly. And that's where those credit cards start to look really tempting. When everyday expenses are more than your income, people turn to plastic to fill the gap.
It's a quick fix, but it can backfire big time.
Absolutely. It leads to a buildup of debt, which becomes even harder to manage when interest rates are rising.
Okay, so inflation is definitely a major factor, squeezing budgets and potentially causing these defaults. What else is on the list?
Well, we can't ignore the Fed's interest rate hikes. Their goal is to fight inflation, but there's a side effect. As the Fed raises rates, borrowing money gets more expensive.
So it's a double whammy for people.
Mm-hmm.
Not only are prices higher, but now their existing debt is costing them more too.
Exactly. Higher interest rates mean higher monthly payments, and for people who are already struggling to get by, those increases can be the tipping point.
Leading to those missed payments and ultimately defaults.
It's a vicious cycle, and it's not just consumer credit that's showing signs of stress. We're also seeing that non-current loans for commercial real estate have hit a 10-year high.
So it's not just individuals. Businesses are feeling the pressure too.
Right, and that raises a big question. Could this be a sign of broader economic weakness spilling over?
Kind of like a canary in a coal mine.
Exactly. It's something to keep an eye on for sure.
Okay, so we're seeing some warning signs in both consumer and commercial lending.
Yeah.
Makes you wonder, is this just a temporary blip? Or is it the start of something bigger? A sign of a recession, maybe?
That's the million-dollar question, right? It's too early to say for sure. There are a lot of factors at play. But one thing's for certain. We need to pay attention to what happens next.
We need to be vigilant and watch for any more signs of trouble.
Absolutely. We'll be keeping a close eye on all of this in the coming weeks and months. Welcome back to Talk Tickers. In part one, we set the stage. We looked at the rise of U.S. credit card defaults, and it's kind of a puzzle, right? Because it's happening at the same time that incomes are going up. So now let's dig a little deeper.
Yeah, let's break it down. We know defaults are up and we have some suspects. But I want to get granular here. What's really pushing people to that breaking point?
Good question. We've talked about inflation and those rising interest rates. Those are the big stressors, right? But let's unpack those a bit more.
Okay, let's start with inflation. How is this hitting people's wallets and their ability to manage that credit card debt? I mean, we're seeing grocery bills through the roof. Energy costs are all over the place. Housing costs are still climbing. How are people supposed to keep up?
Yeah, it's a lot to deal with. The thing about inflation, even when wages are rising, is that it eats away at your buying power. Every dollar just doesn't stretch as far as it used to. So even if you get a raise, if the cost of those everyday things you need is going up even faster, you're actually losing ground.
It's like you're working harder and harder just to stay in the same place.
Exactly. And that's when people start to rely on those credit cards, to bridge the gap,
Yeah.
cover those unexpected costs, or just to make ends meet.
Yeah, it's a tempting solution,
Yeah,
but it's only temporary.
right. And it comes at a cost. You end up with a pile of debt that gets harder and harder to manage, especially with interest rates going up.
Speaking of which, let's talk about the elephant in the room. The Fed's interest rate hikes. I know they're trying to control inflation, but how is this impacting people who are already struggling with debt?
Well, as the Fed keeps raising rates, it gets more expensive to borrow money. That means higher interest payments on everything, mortgages, auto loans, and yep, you guessed it, credit cards. So those credit card balances that might have seemed manageable before, suddenly they're a lot more expensive to carry.
So it's not just about how much debt you have, it's about how much that debt is costing you.
Exactly. Higher rates mean higher monthly payments. And if you're already stretched thin, those extra payments can be what pushes you over the edge.
And then you end up with missed payments, late fees, and eventually default.
It's a vicious cycle, unfortunately. And the economic outlook isn't very encouraging right now. Many experts are predicting that inflation will stick around for a while, and the Fed has hinted that more rate hikes are coming.
So it sounds like consumers are in for a rough ride.
It's definitely a challenging time, but there are things people can do to protect themselves.
Okay, so let's talk about that. What steps can our listeners take to navigate these choppy waters?
Well, the first step is to get real with yourself about your spending habits. Look at your budget, see where you can cut back. Try to build up an emergency fund. That can help you weather those unexpected financial storms.
Consider advice. It's easy to feel helpless when you're facing these big economic forces, but taking control of your own finances can give you some peace of mind.
Exactly. And remember, not all banks are created equal. Some are more vulnerable than others in this kind of environment, especially smaller banks that might have a lot of risky loans on their books.
So it's a good time to check in on your bank or credit union. Make sure you're comfortable with their level of risk.
Exactly. Knowledge is power, especially when it comes to your money. Now let's talk about another piece of the puzzle. We're seeing a shift in how people are spending their money.
Oh, interesting. We touched on this earlier, but I want to dig a little deeper. How are spending habits changing? And what impact is that having on credit card debt?
Well, it's a mixed bag. On one hand, we're seeing people pull back on discretionary spending. Things like vacations, dining out, entertainment, all those fun extras.
So people are tightening their belts a bit.
Yeah, they're being more cautious. But here's the thing. Spending on essentials like groceries, healthcare, transportation, that's staying strong. And with inflation, those costs are still going up. So it's a real squeeze on budgets.
So people are cutting back where they can, but those essential expenses are still there. And they're taking up a bigger chunk of people's income, which could lead them to rely even more on credit cards.
Exactly. And the more people depend on those cards, the greater the risk of missed payments and defaults. It's a delicate balance, and it highlights how important it is to be smart about managing your debt.
Okay, so we've got inflation, rising interest rates, and changing spending habits, all contributing to this surge in defaults. Is there anything else we need to factor in?
Yeah, there's one more thing. The composition of credit card debt itself is changing. The types of loans that are being packaged into these credit card-backed securities, they're evolving. And that could be playing a role in those default rates. We're seeing a rise in the proportion of loans that are classified as CCC, which are considered riskier.
Hold on. So not all credit card debt is the same.
Right. There are different levels of risk, and this trend towards riskier debt within those portfolios, it could be amplifying the impact of inflation and those rate hikes.
So it's like a recipe for disaster. You've got those economic pressures pushing people into debt. And then you've got this shift towards riskier lending practices within the credit card industry itself. No wonder defaults are on the rise.
You got it. We're in uncharted territory here. It's important to stay informed and adapt to these changes, and most importantly, to make smart financial decisions based on your own situation.
Well said. We've covered a lot of ground here, but there's still more to explore. In part 3, we'll look at what these rising defaults could mean for the economy as a whole, and we'll talk about what investors should be watching. Welcome back to Talk Tickers. This is the final part of our deep dive into rising U.S. credit card defaults. We've talked about what's causing them and how they're impacting consumers. Now let's zoom out and think about the big picture. What does this all mean for the economy? And what should investors be paying attention to?
And those are the big questions right now. Economists and market watchers are definitely on edge. You can think of these rising defaults as like a tremor, a sign that something might be shifting beneath the surface of the economy.
So if those defaults keep going up, what kind of ripple effects could we see? What's the worst case scenario here?
Well, the big worry is a credit crunch. As defaults rise, banks get more cautious about lending. They tighten up their standards so it's harder for people and businesses to get loans. And that can really slow down economic activity.
Makes sense. If businesses can't get loans to invest and grow, and consumers are struggling with debt and cutting back on spending, it creates this downward spiral.
Exactly. And that's what economists are talking about when they say recession. It's a period where the economy shrinks. GDP goes down, unemployment goes up, people spend less.
Okay, so that's the gloomy outlook. But is there any chance this could actually lead to a more stable economy in the long run?
It's possible. Sometimes you need a bit of a shakeup. When people and businesses reduce their debt, that's called deleveraging. And it can lead to a more balanced financial system in the long term.
So like a forest fire that clears out the underbrush and makes way for new growth.
Yeah, something like that. And we have to remember that the U.S. economy is pretty resilient. We've been through tough times before, and we have tools to help us weather the storm, things like monetary policy and fiscal policy.
Let's hope those tools work. Now let's switch gears and talk about what this means for investors. What should they be thinking about as they navigate this changing landscape?
In times like these, it's super important for investors to be smart and strategic. You can't just sit back and watch. You need to actively manage your portfolio, do your research, understand your risk tolerance.
So any specific advice for investors who are trying to figure this all out?
First and foremost, focus on quality. Look for companies that have strong balance sheets, solid cash flows, and a track record of weathering economic storms. Those are the businesses that are most likely to come out on top.
Makes sense. Bet on the horses that have proven they can run the race. What about specific industries? Are there any that look particularly risky or safe right now?
Well, sectors that rely heavily on consumer spending. Those are the ones that could struggle if people keep tightening their belts. Think things like discretionary retail and hospitality. On the other hand, healthcare consumer staples, utilities, those tend to be more stable because people need those goods and services no matter what the economy is doing.
So a shift towards those more essential businesses might be a good strategy.
It's worth considering. And you might also think about diversifying into alternative assets like gold or real estate. Those have historically been good hedges against inflation and economic uncertainty.
We're a stock-focused podcast, but we can't ignore bonds. How are these rising defaults impacting the bond market?
Well, when defaults go up, the risk of holding corporate bonds goes up too, especially those issued by companies with lower credit ratings. And that can lead to wider credit spreads, meaning investors want higher yields to compensate for that risk.
So bonds become less appealing?
Not necessarily. It depends on your risk tolerance. If you're okay with more risk, you might find some good opportunities in those higher yielding bonds. But if you're looking for safety and stability, stick with government bonds or highly rated corporate debt.
Okay, so lots for investors to think about in this environment. The key is to stay informed, do your research, and make active decisions based on your own risk tolerance and goals.
Exactly. Don't just sit on your hands. Now, I know you want to get to our This Is Not Financial Advice segment.
Always a fun way to wrap things up. But just to be clear, folks, this is purely hypothetical and for entertainment purposes only. Okay, hit me with it. What outrageous but plausible trade ideas are you thinking about?
All right, so given all this talk about credit card defaults, how about this? We short the highest yielding tranche of a recent vintage post-pandemic reinvesting middle market CLO.
CLOs can be a bit complex for some of our listeners. Break that down for us. What's the logic?
Okay, so the idea is we're betting that those default rates keep climbing, especially in the middle market. And if that happens, the people holding those risky CLO tranches, the ones with the big yields, they're going to take a hit.
Sounds like a high-risk, high-reward play. Not for the faint of heart.
Definitely. Not recommending it. Just a thought experiment, to show how these economic shifts can create opportunities or at least interesting risks.
And to reiterate, everyone, this is not financial advice. We're just two podcasters having a little fun here. Do your own research, talk to a financial advisor, and make your own decisions based on your situation.
Couldn't have said it better myself.
All right, that wraps up our deep dive into the world of rising credit card defaults. Hope you found it insightful and maybe even a little bit entertaining. Thanks for joining us on Talk Tickers. Stay curious, stay informed, and as always, happy investing.